Okay, thank you everyone for joining in. This is Raj and welcome to our webinar. This is India's first SM REIT that is launched, and we are happy to present to you the webinar on PropShare Platina.
Hi everyone, this
Quick
is Rishi.
disclaimers.
Yes, sir. Go ahead.
Yeah. Quick disclaimer, this should not be considered as investment advice. This presentation is only for educational purposes. Evaluation is as per inherent real estate investment characteristics, and we'll explain that as we go along. And we request that you keep the questions for later until we finish the presentation, so we can answer them one by one towards the end. With that, a quick introduction. Hi, my name is Raja. I'm the co-founder at Invest in Pre-Leased. Traditionally, I have experience of real estate transactions in Burli, Prabhadevi area. I do residential and commercial transactions, and with 18 years of experience. Uh, Rishi also is a real estate consultant based out of Ghatkopar, and he focuses on commercial real estate. The reason why we got together is to focus on pre-leased assets. And when fractional came about, we realized that there is a big need to talk about fractional and educate and bring awareness about the entire asset class. And that's how we started doing our reviews. And over to Rishi for a quick introduction.
Hey, hi, hi everyone. Thank you for spending time out here. I'm Rishi Dedia. I'm also a real estate consultant based out of Mumbai for the last 15 years. Like Raj mentioned, we predominantly focus into commercial real estate where we take care of office spaces, retail, industrial, and warehousing. So we understand those assets from investment perspective as well as end use perspective. Together with Raj, we co-founded Investment Pre-Lease. Again, the dire need. We've been tracking this industry, the fractional ownership, for a very long time now, as in for last 5 years, and we have seen quite a good amount of growth and traction. All put together, four big companies are managing close to around 4,000 crores worth of asset. And today we see the first SM REIT asset going live. I think it's live since yesterday. So we really feel that this platform has a lot of opportunity to offer to the retail investors. And that's why we're more than happy to add value in our way. Thank you so much. With this, I think we can move ahead, Raj. Yeah. So I'll quickly run you through the SM REITs structure. 2023 is where the SEBI came in with the first white paper with regards to SM REITs. Now, SM REITs basically stands for Small and Medium Real Estate Investment Trust. Real Estate Investment Trust has been introduced in India back in 2019, and we saw fractional market evolving after 2020, like since 2020. So, to ensure that it gets regulated and retail investors have a fair opportunity, understanding the risk and also their money is safeguarded, SEBI came out with the SM REIT structure. Quickly giving you a basic brief, SM REIT structure has the scheme has four main important pillars. That is investment manager, who basically takes care of your investment in terms of day-to-day operations, managing the asset, compliances, and all. You have a trustee. Trustee is basically a third party which takes care of all your documentation and everything. So tomorrow the investors entire asset documentation, everything is protected under them, and it's a third party asset, so it doesn't, you're safe. Basically, it keeps your investment safe. When you then there is an SPV, technically a special purpose vehicle that's get created for holding the asset, and a unit holder basically is a unit holder of that particular SPV. So all in all, these are the four pillars of the small and medium REITs. Yes, Raj, we can go ahead.
So, just to clarify who this is for, typically SM REITs is for people who want recurring income with capital appreciation. They don't want property management hassles and also low volatility because property prices don't jump up and down as much as maybe stocks. And also, this is recommended for somebody who wants a longer duration. And by longer duration, I mean 3 to 10 years. So now we move on to our actual review of the product. First thing is, first thing that people think of is risks. So I'm going to talk about the risks and how they are being mitigated. So number one is, is this product regulated, right? So, well, we're giving it a 1.5 weightage on a score of 10. And the reason why it's so important is because of, bunch of things. One, Because it's listed, your shares are going to be tradable. They'll be in your demat account, and you can trade them as in your stocks and your mutual funds. So that's one big plus, right? Number two, in case there is a complaint, you have the Squads dashboard by SEBI. There is a watchdog now, so that you can go and complain to them. Uh, Prior to this, in fractional, I mean, you could complain, but where would you do it, right? So this kind of streamlines a lot of things, and because there's a watchdog, it's going to be far more efficient. Number three, SEBI has made the entire process standardized, right from giving license to the right kind of people. So, in terms of criteria, they need to have real estate experience. They need to have, net worth of, let's say, 20 crores, and all those things have been taken care of by SEBI, which is wonderful. And which is why when there is a regulated product, it kind of lends itself uh, to a better investment option. So now that it's regulated, we give it 1.5 on 1.5. There are other risks in some sense. People may say that, what about the capital risk? And this is what I was talking about earlier. Well, real estate prices don't fluctuate that much. And therefore, you never see a property go from, let's say, 100 to 0, right? Or maybe 30 for that matter. Because of market fluctuations, prices can go up and down, of course, and that may reflect on the NAV of your share eventually. But, largely the capital is intact because of, again, low volatility. So therefore, we're scoring it as a low risk. In terms of vacancy risk, can the property get vacated by the current tenant? Yes, it is a pre-leased asset and a rent-yielding asset, which, as a SEBI has kind of defined that it has to be a rent yielding asset. Thankfully, there's no under construction because again that comes with certain kind of risks. And so coming back to vacancy, well, couple of factors why according to us, it's a low risk. Number one, it's a sale and lease back. So 24/7 AI themselves bought the property. Yeah, they customized it according to their needs, and now they're going back on lease. So typically, there is a higher amount of stickiness for these kind of properties when it's a sale and lease back. Number two, the other criteria that one needs to understand and be aware of is the fact that the rentals that we are getting is in and around what ORR commands for a A-grade building, right? Prestige Tech Platinum. So therefore, worst case scenario, if the tenant was to leave, you will be able to find a replacement. And again, with a professional investment manager like PropertyShare, knowing them, obviously they will be involved to the extent that they will know there will be a notice period. So it's not going to be that immediately those guys will vacate. If at all a situation arises, there's going to be a lead time, which will again help uh, PropertyShare find another tenant, right? For all those reasons, we feel it's a low risk. And finally, in terms of liquidity risk, uh, number one, again, has to be seen in conjunction with existing real estate. If you want to sell your own real estate, it will take anything from 4 to 6 months. So from that perspective, the liquidity now that it is tradable is definitely better. But initially, like in the first year or so, we may not see so much of trading happening. But our sense is that within the next 2 years or so, there's going to be a lot of schemes that are going to be there, and there's going to be a lot of investor participation, and which that will mean that the tradability of that will go up. Also, while we're looking at a 2 year horizon, if you're looking at investing for less than 2 years, this product is not for you. We don't recommend that you invest in this, for that matter, any real estate for less than maybe 5 years, right? Ideal time is 5 to 10, 15 years, right? So moving on, 1.5 on 1.5 in terms of knowing your risks and mitigating those. Over to the asset.
Yes, thanks, Raj. So, know your asset now. We generally are very focused on what kind of asset you're investing. If you look at our previous reviews, also, we have been very vocal about the asset as per se, as in the grade of the asset, what kind of asset you're investing in, because technically, it's the location and the asset that you are actually investing into. They play one of the most critical roles while you are selecting your asset for investment. So when we talk of this is an SM REIT, of course, structured in a packet of shares and all as an asset class where SEBI is coming in. But at the end of the day, you are actually investing into a real estate asset. So you really need to be aware of what kind of asset and what location you are investing into. Starting with this, we look at city, that is the ease of living score. Here, we see the points that have come. So we know Bangalore or Bengaluru as a city or the Silicon Valley of India, and we have seen a lot of movement in terms of people coming in. There are a lot of people staying there. So when we look at what do you mean by city ease of living score? Basically, there are four main criteria that are being captured here. That is institutional, social, economic, and physical. Now, on all these four criteria, there is a survey that's being done with the people living in what kind of infrastructure is being provided, what is the cost of living, what is the social atmosphere out here, whether there is institutions that are present here. So all in all, we look at that, and there is a particular rating that's been done, and Bangalore scores one for across India, and that's the reason we have given zero point 0.3 on 0.3. Now, what is the location? Now, CBD is basically, it stands for Central Business District. Our entire discussion boils down to Outer Ring Road. Now, this asset is particularly located in the Outer Ring Road, and Outer Ring Road is currently the hub of all the MNCs, particularly Fortune 500 companies coming in. Now, that entire stretch of Outer Ring Road, we see a lot of movement right now in terms of a lot of tech parks coming on, in terms of development already developed, a lot of development happening around, and you see a lot of companies that are already housed there. You look at the infrastructure, the road network. There is an upcoming metro station. So, in terms of location, there is connectivity, there is access. You have all the important infrastructure. For example, a residential which is accessible. You have school, you have hospitals in the vicinity, and that's the reason we always want what is that location plays a very key role for any asset to grow when you are investing into. And we all know Bangalore has its own challenges with regards to the traffic that's going on. So when we look at this micro market, we feel that Outer Ring Road is actually a value location to remain invested in. And that's the reason we are going with zero point 0.3 on zero point 0.3. Now, proximity to a metro station or a transit hub, this is now becoming very, very crucial. Like I touched upon a point, which is traffic. We all understand that we have read news, we have seen such some situations in Bangalore also where traffic was a big challenge. That's the reason we would want that the metro commute or the commute to a transit hub becomes very, very important. Now, in this particular asset, we we have a metro station that's coming up, not functional yet, but it is yet to start, and that's the reason we haven't given it's a to a, we have a very close proximity to it, but we would want to wait for it to be operational because as of now, the people don't have that kind of access to that. So that's the reason we have taken zero, given zero out there. Built by a listed developer. Now, if you have seen our previous reviews, we have upgraded this review the way we are doing our reviews. So this is 3.0. We had a 2.0 version in place. Now it's a 3.0. We specifically, I and Raj were debating on this whether should we have a listed developer, what kind of, and why listed developer. So we came down to a point where a listed developer it takes a lot of things for a listed developer to actually remain listed or go for even listing for the first time. So you look at all the top 5, top 10 developers who are performing really well are actually listed developers. There is a lot of compliance that is in place, a lot of financial audits that keep happening. They need to ensure that the projects are getting delivered because finally it will affect the stock. So all in all, when we looked at, we really felt that okay, this is one criteria which will actually help investors to understand that whether the investment is safe or not, what kind of development is happening here. Again, the Prestige is the developer out here which has developed the project. It's a listed developer, and that's the reason we have given 0.3 on 0.3. OCDC, the occupation certificate. Now, for any tenant, for that matter, be it an MNC or a small SME or an individual, OC always plays the most critical role because your compliances are dependent on it, the loans dependent on that, and we always feel that the occupation certificate has to be always in place because that gives you a factor where your all the compliances with regards to the buildings are in place. Here, the OC is already in place, so 0.3 on 0.3. IGBC, that is India Green Building Council, lead rating. Now, this is something that's very, very important, particularly for the MNC tenants, particularly for the multinational companies or the Fortune 500. They really value this. More and more, we are looking at people looking at sustainability, people looking at green atmosphere. They want to ensure that we use our resources really well. So a LEED certificate building is basically where your building or the structures are made in certain way, the materials that are used, your resources in terms of rainwater harvesting, your solar lighting, your all water management, wastewater management system, your waste management system, all this being a part of the entire ecosystem. So that's the reason there is a rating that's there for a green building. And here in this case, it's a gold rated. So we have made a mistake here. It's point two. So it's out of zero point 0.3. So for a platinum, we will be probably giving a zero point 0.3, and for gold, we'll be giving zero point 0.2, and for silver will be going 0.1. So this is a gold rated building. The shell and core are technically gold rated, LEED certified building. So that's the reason we'll be going with 0.2. Parking ratio. This is a very, very critical one. Yes, Raj,
Rishi,
sorry.
sorry, I have a question regarding the lead rating.
Please.
How does that impact the investment?
Oh, this becomes very, very important when a building is being shortlisted by any of the tenant. A tenant would always look at its outflows, and from the investment perspective, also you would want to look at your outflows. So your maintenance upkeep of the building will go low. Your energy resources consumption will go low, and that will in effect help you on your savings. So this is why this criteria is very, very important. Of course, it definitely helps with the managing the ecosystem around. But it also keeps your outflows low, and that's the reason. For example, a very simple example: solar lighting can actually bring down your electricity bill by a good amount of by a good percentage of amount. So technically, that's the reason this is also given a lot of weightage to. Moving next to parking ratio. This is one of the most critical things. We generally would want to look at one car park for a 500 square feet that is there in terms of usage. Generally, that's the best ratio to have in the current situation. But as we see the cost rising, compliance is there, the traffic moving, we have seen that developers have probably gotten down to 700 to 1,000 or to 1,500 square feet. I mean, one parking for 1,500 square feet or 1,000. In this case, we are somewhere near 700. So that's the reason we have kept it. So it is between 500 to 1,000. So we have kept it at 0.2. That's the reason it's getting 0.2 and 0.3. Now, can this asset be divided with an independent access? Now, technically, we see there are 6 floors in this, and they can be individually accessed without being interconnected. Yes. So tomorrow, if we want to lease out any one particular floor, or even want to break into two, yes, that's possible because they have accesses, and they also do have access to the wet areas wherein your toilets and toilets can be deployed. So technically, yes, in this case, it's there. It can be subdivided. Now, this comes into handy where asset needs to be subdivided, maybe floor by floor, or maybe the floor needs to be subdivided further. So that comes handy when you want to release the asset if the current tenant moves out, and it comes handy. So yes, it can be subdivided, and that's reason 0.2 and 0.2. Now, if you look at one of the very important amenity, that's crash. Now, crash is basically there are parents, be it fathers, mothers, who have working parents who have probably infants right from the age of 6 months going up to 3 or 4 year olds who can't be left at home. Maybe they have support system, maybe don't. So crash is basically something that helps them. It's a play area kind of situation, or a daycare, which we generally call it as. And that's one of the amenity that's provided in larger grade A assets across the globe. If you look at grade A assets across US, UK, you will see this feature, and it helps maintaining the employees as well. I mean, to ensure that they are around their kids, and they can. There's a lot of support system that's provided by the employer. So technically, in this building, they don't have a crash, and that's the reason we are taking over that point one. Amenities, of course, we do have a garden, an amphitheater, and a cricket pitch out here. Generally, any grade A facility will always have a fitness center, a grocery shop for the employees' convenience. So we this has been a trend and norm, and we have seen in a lot of grade A assets. This is part of being the ecosystem. In this case, we don't have the grocery and the fitness area, and that's the reason we are giving 0.1 and 0.3. Again, next, very, very critical important point, we have been always vocal about going to the ground and assessing the asset, looking in around the scenario, what's the situation out there, whether actually outer ring road, the way they are saying, actually is it there, not there, what kind of movement it is there. So we would want to bring to the viewers notice that we ensure that we visit our assets, whatever majority of our assets, we have tried and visited those assets, and we give you that ground review as to exactly what is being shown in the picture is actually there or not, and we do our own survey. So in this case, I and Raj, we both have physically visited this asset, not together, separately. But yes, we have visited and we have seen the building. So yes, this brings us to the entire review as 2.2 on pre. Yes, Raj, what about the terms and conditions that are lying ahead?
So now we move on to the third aspect of knowing the terms and the returns, which again, if you see the overall weightage is 4, and on the extreme right of your screen, you will see what we have scored or the opportunity scores. Well, number one is duration. We want a minimum of 5 year of duration for any pre-leased asset that one invests in. In this case, it's a 9 year agreement, so it gets point 0.3 on point 0.3. We recommend a lock-in of at least 3 years. Uh, in this case, there are multiple floors, and the weighted, lock-in is 4.6 years, but again, it's above 3 years. So therefore, we give it full marks, point 0.3 on point 0.3. In terms of penalty and corporate guarantee, so typically, let's say, for example, you get into a leave and license agreement or a lease agreement, and in case somebody breaks the lock-in, is there a penalty clause, or sometimes there's a corporate guarantee, right? So those are desirable. In this case, currently it's a sale and lease back, so the leave and license agreement is not in place, and they will be done as soon as the transaction happens. Right, but for that reason, currently we cannot give it any point, so it's 0 and 0.2. Also, again, for a pre-leased asset, we would ideally like the agreement to be registered. And in this case, again, like we mentioned, the agreement is going to happen later. And for that reason, we've scored 0 on 0.4. Also, just to let the viewers know, we've already communicated to SEBI from our end that ideally, with the SM REITs documentation, these leave and license documents and the title documents ideally should be available on demand, if somebody wants to go through it. So, that's something that we've already, sent to SEBI as feedback. And coming back to increment, the ideal industry standard is 5% every year or 15% every 3 years. In this case, it's 3.86% after 3 years, which is very low. So therefore, we give it 0.05 on 0.25. Rent start date, typically we think that within, as soon as the money goes in, around 45 days is ideal. 30 to 45 days it takes. Even in fractional, we've seen, because there's certain amount of compliance, etc. Passport needs to be uploaded, signed, registered, and uploaded, etc. And all of those things. Right. Similarly, because of compliance, we think 45 days is fair enough. So here in this case, I think ground to, if I'm not mistaken, ground to third floors, the rent starts on 1st of Jan 2025, and for the other floors it starts in Feb 2025. So we are in and around, so therefore, point 0.2 on point 0.2 there. In terms of deposit, we have a 6 months deposit. The reason why a 6 month deposit is required is because, for such a large property, right? It adds as a backup. Let's say, in this case, we don't expect that sort of a situation, but this is just as a discussion. In case the rentals are delayed, right? So then you have 6 months worth of rent, right? It's very critical to have that. So if it's anything less than 6 months, we'll rate it accordingly. In this case, it is 6 months. So uh, 0.25 on 0.25 there. In terms of the notice period, currently the leave and license agreement is not in place, and we couldn't find a notice period mentioned in the documentation. And so therefore, we're rating it 0 on 0.3. The reason why notice period is critical, again, we want 6 months, is because, again, in case the tenant wants to leave, these are large properties with huge floor plates, right? Typically, a lot of these fractional or SM REITs will be anything from 20,000 going up to 50, 60, 80,000 square feet, right? So it's not easy to rent them out overnight. It takes time, right? Even if the property is shortlisted, the tenants will have their compliances to follow, and they will have a process in terms of getting approvals, and various teams get involved. It's not just the commercial team, you have the legal, etc. All of those guys get involved. So all of this definitely takes time. And therefore, we want, in all properties, a 6 months notice period minimum. Now, coming to return on investment, the rental yield, uh, you know, people may be talking about the rental yield first, but we prefer to go through all these terms because those are critical as well. Uh, so we are getting a 8.67%, 8.7% as an average for the first 3 years. And the reason why we take the first year average is, again, with fractal, we've seen that the first year yield looks very attractive because the management fee is waived off and there's a cashback and all of that. So the right way to look at it is the net uh, return pre-tax for the first 3 years. And in this case, it's 8.7, 8.666, 8.7, and which is wonderful. We want a minimum of 8%, so it passes that criteria, and therefore full one on one there. Um, in terms of tenant stickiness, uh, how we want to ensure that the tenant sticks around and their rental should be lower or in and around the market price. So currently, the pricing for A grade assets on Outer Ring Road is between 95 to 105 approximately, and we are in and around that price, right? So therefore, we think that the tenant will stick around, and also the fact that it's a sale and lease back, which we discussed earlier, is the reason why they will stick around, right? Another aspect is whether the tenant has spent money on the property, right? So in this case, they've done the fit outs themselves. So therefore, it's a big plus for us because the fact that they've invested in the property, which means that they're not going to. It won't make sense for them to leave the property. Even if you have a similar, or let's say a 5-10% lower uh, rental somewhere, because there's a cost of moving. They will have to do the furniture and furnishing even in the new property. There'll be a waiting time. They'll have from also from a perspective of moving all the team members, etc. So therefore, we like that a tenant has put in capital in the property, and therefore zero point 0.4 on zero point 0.4 there. So this takes our total average to 2.9 on 4. As soon as the leave and license agreement is in place, obviously the rating would go up. But at this point in time, we will stick with what's there currently. And now to the last point, which is tenant and investment manager. Rishi, what's your evaluation?
Yep. So we also equally levied on our weightage to this particular aspect also, because both of these gentlemen are very important, the tenant and the asset manager. In this case, we have tenant, which is again a US based entity, but it's not a Fortune 500. Somewhere we feel that if it's a Fortune 500, it always gives you a comfort in terms of the kind of work they're doing, and they would be remaining there for a longer time. Of course, here we also know that we 24/7 AI should be remaining here for a good time. But since it's not a Fortune 500 company, we have not given any points to them. That's 0 and 0.2. Is the tenant profitable? Now, this is something that's very, very important, because there are a lot of we are in an era of a lot of startups functioning, and we have nothing against, because startups need that kind of funding, and they might be not profitable initially, and they'll be profitable along the run of journey. But we always feel that if the tenant is profitable, the longevity of a tenant being there in that asset becomes more and more predictable, that they will be there for a longer time. So that's the reason we really emphasize that whether this tenant is profitable or not. As per the ICRA website, this tenant is profitable. We see approximately 31.9% of profit that is there in 9 months of 2024. So yes, point two and point two for that. Coming to the asset manager, we really feel that whatever AUM is basically asset under management. We really feel that this is a very critical point, because every asset that you manage and you have it under your belt is a learning curve for the asset manager. In this case, we have divided as AUM for SM REITs and AUM for fractional. Reason is up till now it was all fractional. This is the first SM REIT asset that is going live, and they don't have any other track record for this. So that's the reason we have given 0 and point 0.3. Now we look at the AUM that is for fractional. So it is 0.2 and 0.3, because as per one of the ET articles, the current AUM under for PropertyShare is roughly around 1,300 odd crores, and every 500 crore we have given 0.1. Like I said, it comes with its own nuances of learning curve, because how the market behaves, what kind of asset comes, what kind of risk appetite you need to be taking, what kind of risk matrix you should be looking into, what kind of tenant, what kind of asset you would want to, and that comes over an experience. Now, these guys definitely have been in the industry for almost 7 to 8 years now. They have a lot of assets under fractional which they have done. They have that experience of understanding that amount. So that's the reason it's point 0.2 and point 0.3. Profitable exit given for any SM REIT. Well, in this case, they have SM REIT doesn't have any exit, because this is going to be the first this is going to be the first asset that will be there on the table, and that's the reason it's 0 on point 0.3. Raj, you'll have to move to the previous screen. Thanks. So where we come to the management fee here, the hurdle rate. Now, hurdle rate was actually part of the fraction earlier, where there was a certain percentage of success fee which they were charging for the exit. In this case, the hurdle rate is not there, but yes, there is a management fee out here. Uh, Technically, as per us, it should be 1.5% or less. In this case, the management fee for the first year is not there. Then there is 0.2% and 0.3% as a perpetual. So every year there will be 0.3%. And that's the reason we see a trend of yield falling in from 9 to 8.8 and then 8.7. So that is going to be the management fee that they're going to charge. Of course, that's the reason we have gone ahead with point 0.2 and point 0.2 for this. Generally, we always feel that management fee should be there in accordance with the investment, and it should be there because there should be something for the investment manager as well to make some money and ensure that they are interested in managing the asset also. So yes, in this case, we have point 2 on 2. With this, we come to point 0.6 on 1.5. And with this, the total rating actually goes to 7.2, not 7.1. We have since this is a gold rated LEED platinum certified building, it gets point 0.2 over there, and that's the reason it's 7.2 on 10. There are two aspects which we will want to touch out here. One is there is a 1.5% a fee that's the investment manager going to charge for the acquisition of this asset. And there is also 3% fees that they are going to charge for the divestment, as in when they are going to give you an exit from this asset, they are going to charge you 3% or whatever is the value that it's there at time of exit. They're going to charge you that. Apart from that, the first year doesn't have the management fee. That's like it's going to be zero. That's the reason you're getting 9% completely. Now, this 9% ROI is technically your pre-tax ROI, that is return on investment. You will have to consider your tax slab and then calculate your own returns. If you if you want a little more about this, we can definitely get on a one-on-one call. And yeah, and the second and the third year, it's second year it's 0.2% and third year is 0.3.
So with that, people might ask us, what are we doing? So we like to, say this that obviously, the famous campaign, mutual fund sahi hai, par kaun sa? There are 2,500 schemes as of today. And we expect a similar thing happening with small and medium REITs. We're going to see an explosion of number of schemes that are going to be active now in the next couple of years, and we hope to be the person who kind of analyzes and tells you about that particular SM REITs, given our real estate background and the fact that we physically go and verify the site the site as well. So here's what we do for investment advisors. We analyze which is the right option, and eventually also what price to buy it at. Now, what price to buy it at is a separate conversation that we can have. Eventually, we see that there's going to be significant money that will be made when there are a lot of schemes that are already live, and if you know what price to buy it at, it's going to be a very lucrative uh, investment option. So with that, for property owners and developers, we offer end-to-end sales and legal consultancy and solutions for fractional and SM REITs. And for asset managers, we help them find the right properties. So we've already helped current asset managers to find a property, and we hope to continue to do that. So now it's Q&A time. happy to answer any questions that you guys might have.
You guys can post your questions in the chat, and probably we'll take one question. Raj, do we have a list of questions?
No.
All right, great. So, is there if there's anything that you would want to ask or understand, we are open for.
Okay, so participants are now allowed to chat. Uh, Feel free to ask questions.
In case you guys would want to get into a one-on-one conversation and not bring it onto the platform, that's also okay. You can reach out to us and we can schedule a call for the same. Raj, do you want to just sum up the discussion? Oh yeah, okay, we have a question. All right. Is there a time period specified when the asset will be divested? No, there is no time period that has been mentioned or specified. Generally, it is with the fractional, the trend that we have seen is the increment happening maybe 5% every or 15% after 3 years. So, 1 to 3 years is where the investors or the asset managers generally wait before they actually start looking or hunting for a suitable buyer, because that's where your appreciation kicks in, as in the escalation kicks in, and your rental increases. So technically, that's the time frame that we have seen as a trend in the fractional assets. In this case, there is no specified time. If I want to answer the question for divestment, again, since it's a SM REIT, they will be coming to you after maybe 2 to 3 years of time, looking at the NAV, or if they have a suitable prospective buyer who have reached out to them, then they need to come out to the unit holders, and they, as a unit holder, you will have to vote whether you want to exit the asset or not. So as of now, no, there is no time period specified.
I'll
Yeah,
take the
Raj, you
next
would
one.
want to take. Yeah.
How should we look at valuing the asset? Is it a cap rate based mechanism or we are benchmarking to other assets in the micro market? So honestly, Aman, it's a combination of both. Uh, Largely, you want to buy a A grade asset at the right price, which is true for any investment, right? Buying it at the right price. Now, buying it at the right price involves a combination of things. One is that, of course, you have to study the micro market. You have to see what's going on, what is the benchmarking of other assets, from a purchase price, from a rental price, right? And that's another deep dive completely. We obviously can't get into complete details on that right now in the webinar, but it requires a detailed study, which is a separate conversation and activity that we do, right, from a valuation perspective. But it's a combination of things that one needs to look at. You know that you will be paying a slight premium for a pre-leased asset, which is fine, but there has to be awareness in terms of what is the benchmarking, etc. We've found certain asset managers or developer inflating the rentals and inflating the price of the property and then selling it, right? And let's say, to give you an example, if the micro market currently demands, let's say, a 60 rupees on square feet, the developers promise, because it's under construction, the developers promise, let's say, 85 rupees for the next 3 years, right? And when the property is eventually ready for possession, at the end of 3 years, the property may not command, 80. It may 80 or 85. It'll maybe 65, 70, right? So all these things are very important. There's a lot of pre-leased activity that is happening right now, but one has to be careful and kind of do benchmarking accordingly.
So we have a
Uh,
question from Gaurav. How it's different from fractional investments technically? A lot of differences, Gaurav. A lot of differences. First and foremost, this is getting regulated by SEBI. So your dependency on the platform really goes low. I mean, initially it was, I mean, if you wanted to exit, technically you were dependent on the asset manager or the platform itself, or probably people like us for the secondary market exit, or you probably were able to. Now, here, the biggest change that we have seen is your dependency for exit goes to no one but on the platform, and the liquidity comes into the play. So that's one of the biggest thing. Also, a lot of compliances come into play. When you are dealing with SEBI, they have laid down a lot of rules for going out with a particular asset getting listed as an SM REIT proposal. So all those compliances. So it basically is like stricter norms, and you have a watchdog like SEBI who is taking care of all your paperwork and all. So and anything going wrong, the compliance. We all know how SEBI can actually come back after you and shut your shop if you are not factually correct. So that gives an added layer of security to the investors. That's fewer technical aspects from the fractional asset investment. More important, the structure of the investment, the way the structure is being played out. Earlier, there were a lot of variable structures that were there. For example, few of them were following private limited, few of them were following LLPs. That piece was missing. So now everything will be standardized, and you will have a very clear structure of product that is coming into the play, which is very very important because when you have a structure like private limited, lot of rights of the investors are being protected, a lot of things are taken into consideration. So that is why when you say this is going to be uniform, and it will be in the investors perspective. So that's what I feel. Raj, what do you want to add on this?
No, largely you covered everything. We've experienced that with fractional, people follow their own processes, right? Even from a legal perspective. So let's say, for example, one asset manager would have an articles of association and would update all the terms between the investor and the SPV in articles of association, whereas somebody else had a shareholder agreement, right? So there was no standardization. There was flexibility. In fact, one of the things that we kept pushing was online meetings. So within the purview and four corners of the private limited laws, you were allowed to have offline meetings. But for fractional, think from a practicality perspective, if there's any decision need to be made, nobody's going to be there, going to be physically, uh, nobody's going to be physically present, right? Even if you're in Bangalore, what are the chances that you're going to be in Bangalore for that meeting? And uh, it is 75% of the people present at the meeting, right? So out of 200 investors, if only 20 turned up, it was 75% of that, which we pushed back and we said that that's not okay. You have to have an option of online, right? Now, SEBI very clearly says there is no offline meeting, it has to be online, which enables investors to participate. Now, whether investors participate or not is a separate question altogether, but at least the option is there, right? So, from that perspective, the biggest thing, according to us, is the fact that it's tradable. Number one, the standardization, and you have a provision to complain if something does go wrong, right? So these are the three things we think it's phenomenal.
Yeah, we missed one more thing, the ticket size. Okay, earlier the ticket size were all in the price band of 15, 20, 25 odd lakhs onwards. Now 10 lakhs coming as a play, it becomes really accessible for an investor who would want to just try this asset out, add it to their asset class. So it becomes really lucrative. And to be honest, SEBI's intent is to further break it down. Once this thing stabilizes, when the proposal keeps coming in, they might again put it down, the value might go down. So to attract more investors, of course, and also to make it liquidable. So that's the intent. So lot of learnings, and we are really excited for this thing happening in, I mean, SM REITs going live.
Right, guys. I think we don't have any more questions. With that, we'll end our webinar here. If you have any questions, feel free to email us, and we'll be happy to answer. And thank you very much for joining. We were also live on YouTube. Feel free to put in comments and suggestions. Thank you very much. Until next time when we do the next SM REITs review. Thank you.
Thank you so much.